Preparing for accounting at Duke Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How do the three financial statements connect? The income statement measures profitability, the balance sheet shows financial position, and the cash flow statement explains changes in cash. Net income begins the operating section and increases retained earnings, while non-cash expenses such as depreciation are added back. Capital expenditures reduce investing cash flow and increase property, plant, and equipment. Debt issuance affects financing cash flow and liabilities. I always check that ending cash reconciles across statements, because that catches classification or posting errors. While answering, focus on net income flowing into retained earnings and operating cash flow, balance sheet changes driving investing and financing cash flows, and the importance of explaining reconciliation rather than memorizing isolated formulas. Question 2. What is unique about accounting for a regulated utility such as Duke Energy? A regulated utility often accounts for costs based on whether regulators permit recovery from, or require refunds to, customers. If a qualifying cost is incurred today but recovered through future rates, the company may record a regulatory asset. Excess collections can create a regulatory liability. I would understand the relevant commission orders, recovery period, and probability of collection before recording anything. That framework makes utility accounting different from ordinary commercial accounting. Make sure to cover cost-based regulation, approved recovery through customer rates, regulatory assets and liabilities, rate-based investment, and the judgment required to determine whether future recovery or refund is probable. Question 3. What is a regulatory asset, and when can Duke Energy record one? A regulatory asset represents a cost recognized under generally accepted accounting principles that the regulator expects the utility to recover from customers in future rates. I would record it only when recovery is probable and supported by regulatory action or established practice. The asset is then amortized as customers pay the related rates. For example, approved storm restoration costs may qualify. If recovery becomes doubtful, I would reassess the balance and consider impairment. In your answer, talk about a deferred cost, probable future recovery through rates, authoritative support such as a commission order, amortization over the recovery period, and impairment if recovery becomes unlikely. Question 4. How would you account for a regulatory liability? A regulatory liability arises when a utility has collected amounts from customers or received benefits that must be returned through future rate reductions or refunds. I would review the governing order, identify the affected customer period, and recognize the liability when the obligation exists. The balance is released as refunds are paid or lower rates are provided. The key judgment is distinguishing a true regulatory obligation from an ordinary accrual or deferred revenue. Be sure to mention amounts collected before related costs are incurred, customer refunds or future rate reductions, the distinction from ordinary operating liabilities, and systematic recognition as the regulatory obligation is satisfied. Question 5. What is rate base, and why does it matter to utility accounting? Rate base is the investment amount on which regulators generally allow a utility to earn a return. It commonly includes eligible plant in service, construction-related balances, and certain working capital, reduced by accumulated depreciation and other offsets. Rate-based treatment matters because approved capital investment can generate depreciation expense and an allowed return through customer rates. I would never assume every asset qualifies. The Commission's rules and timing determine inclusion. Focus on the regulated asset base used to determine allowed returns, eligible utility plant and working capital, depreciation and accumulated depreciation, and how capital investment can affect both earnings and customer rates. Question 6. Explain allowance for funds used during construction, or AFUDC. AFUDC capitalizes an allowance for financing costs incurred while qualifying utility assets are under construction. Instead of expensing the cost immediately, the utility adds it to the project's carrying value, often separating debt and equity components under regulatory guidance. Once the asset enters service, the capitalized amount is depreciated or recovered through rates over time. I would verify construction status, approved methodology, and capitalization limits before recording AFUDC. In your answer, cover financing costs accumulated during construction, capitalization rather than immediate expense recognition, the difference between debt and equity components, and subsequent depreciation or recovery through rates. Question 7. How would you evaluate whether a project cost should be capitalized or expensed? I would capitalize a cost when it creates or improves a long-lived asset and provides probable future benefit, such as constructing a substation or extending a transmission line. Routine repairs and maintenance that only preserve existing condition are generally expensed. I would examine invoices, work orders, project authorization, and the assets in service date. For borderline items, I would apply Duke's policy, materiality thresholds, and regulatory treatment consistently, then document the judgment. Make sure to cover future economic benefit, placing an asset in service, repairs versus improvements, direct construction costs, internal labor, materiality, and consistency with company policy and regulatory requirements. Question 8. How is depreciation calculated for utility property, plant, and equipment? For utility PP&E, depreciation generally allocates depreciable cost over the asset's useful life, often using straight-line or group depreciation methods approved by regulators. The calculation begins when the asset is placed in service and includes the appropriate depreciable basis, less residual value where relevant. I would reconcile additions, retirements, and accumulated depreciation, then assess whether updated engineering or regulatory information changes useful lives or depreciation rates. Discuss depreciable basis, useful life, residual value, straight line or approved group methods, in-service dates, accumulated depreciation, and reassessment when technology, regulation, or retirement expectations change. Question 9. What is the difference between construction work in progress and plant in service? Construction work in progress contains costs for an asset that is not yet ready for its intended use. It normally is not depreciated, although eligible financing costs may be capitalized. When construction is complete and the asset is placed in service, the balance moves to plant in service, depreciation begins, and rate-based treatment may change. I would validate the completion certificate, final costs, asset record, and in-service date before transferring the balance. In your answer, distinguish assets still being built from assets available for their intended use, explain depreciation and AFUDC implications, and discuss the importance of accurate project closeout and in-service dates. Question 10. How would you account for an asset retirement obligation at a nuclear or fossil fuel facility? I would recognize an asset retirement obligation when a legal obligation exists to retire or remediate a long-lived asset and the liability can be reasonably estimated. The initial obligation is measured at present value, with a corresponding increase to the asset's carrying amount. Over time, the liability accretes and the capitalized asset retirement cost is depreciated. I would update assumptions for timing, technology, inflation, and expected remediation costs at each reporting period. Be sure to mention legal or constructive retirement obligations, present value measurement, discounting, accretion expense, revisions to cash flow estimates, and capitalization of the initial liability into the related asset. Question 11. How would a major storm affect Duke Energy's financial statements? A major storm can create substantial restoration expense, payables, inventory usage, overtime, and cash outflows. I would classify costs between repair expense and capital replacement, then evaluate insurance recoveries and whether regulators authorize future customer recovery. Qualifying recoverable costs may be recorded as a regulatory asset rather than fully expensed immediately. I would maintain detailed storm-specific support, update estimates, and avoid netting recoveries against costs without appropriate accounting support. Focus on restoration costs, insurance recoveries, customer recovery through rates, regulatory assets, expense timing, cash flow, estimates, and the need to distinguish recoverable costs from normal maintenance or capital replacements. Question 12. How do you account for environmental remediation costs? I would accrue environmental remediation costs when a loss is probable and reasonably estimable, based on investigation findings, legal obligations, engineering assessments, and settlement expectations. If a range exists without a better estimate, the applicable accounting guidance determines the recorded amount. I would separately evaluate insurance reimbursement and potential regulatory recovery rather than assuming either is certain. Significant uncertainty should be reflected through disclosures, updated estimates, and documented review. In your answer, discuss probable and reasonably estimable obligations, loss accruals, asset retirement considerations, regulatory recovery, insurance, uncertainty ranges, and disclosure requirements when estimates remain material. Question 13. What accounting issues arise from power purchase agreements? A power purchase agreement requires careful analysis because it may contain a lease, a derivative, or an executory supply contract. I would determine whether Duke controls an identified generation asset, evaluate fixed and variable payments, and assess energy, capacity, and market price features. The contract's economics and embedded terms drive classification and measurement. I would involve legal and technical teams early, because a missed clause can materially affect liabilities, expenses, and disclosures. Make sure to cover contract review, identified assets, lease accounting, variable payments, energy and capacity commitments, derivatives, executory contracts, and coordination between accounting, legal, and operations teams. Question 14. How would you analyze a lease under ASC 842? I start by asking whether the contract gives Duke the right to control use of an identified asset for a period in exchange for consideration. If so, I determine the lease term, payment schedule, renewal options, and discount rate, then recognize the appropriate right of use asset and lease liability. I also check for embedded leases in service agreements. Strong contract inventories and review controls are essential because leases may sit outside the central procurement system. Discuss identified assets, control of use, lease term, discount rate, right of use assets, lease liabilities, modifications, embedded leases, and completeness controls over contracts across operating locations. Question 15. What is your approach to deferred tax accounting for a utility? Deferred taxes arise because book and tax recognize income or deductions at different times. For a utility, accelerated tax depreciation can create a deferred tax liability while book depreciation is recognized over a longer period. I would calculate temporary differences by asset class, apply enacted tax rates, assess valuation allowances, and consider regulatory normalization requirements. I would reconcile the tax provision to the return and explain significant changes rather than relying only on the effective tax rate. Focus on temporary differences, deferred tax assets and liabilities, accelerated tax depreciation, regulatory normalization, valuation allowances, rate effects, and reconciliation of book and tax basis by asset class. Question 16. How would you perform a monthly account reconciliation? I would begin by agreeing the general ledger balance to an independent subledger, bank statement, schedule, or external confirmation, depending on the account. Next, I would explain every reconciling item, verify supporting documentation, and assess whether entries are needed before close. I would age open items, escalate unusual or material differences, and obtain documented review. A reconciliation is complete only when the balance is supported and unresolved items have clear owners and deadlines. Be sure to mention agreeing the general ledger to supporting detail, investigating reconciling items, aging unresolved balances, documenting preparer and reviewer evidence, and escalating unusual or material differences promptly. Question 17. Describe an effective internal control over financial reporting. An effective control directly addresses a defined financial reporting risk and produces persuasive evidence that the control operated as designed. For example, an independent reviewer could compare monthly capital additions to approved work orders, invoices, and in-service documentation before posting. I would evaluate the reviewer's qualifications, timing, precision, follow-up on exceptions, and segregation of duties. Testing should confirm both design and consistent operation, not merely the existence of a signed checklist. In your answer, include the risk addressed, control owner, frequency, evidence, segregation of duties, precision, review criteria, and how you would test both design and operating effectiveness. Question 18. What would you do if a close deadline conflicts with an unresolved accounting issue? I would first quantify the potential impact and determine whether the issue affects recognition, classification, disclosure, or regulatory reporting. I would gather available evidence, involve the controller or technical accounting team, and document the judgment. If a reasonable estimate is permitted, I would record it with a clear basis and plan a true-up. I would never bypass approval or conceal uncertainty to meet the deadline. Timely escalation protects both accuracy and credibility. Focus on materiality, escalation, evidence-based estimation, transparent communication, temporary entries where appropriate, subsequent true-up, and preserving control quality rather than sacrificing accuracy for speed. Question 19. How would you investigate an unexpected variance in operating expenses? I would quantify the variance, compare it with budget and prior periods, and decompose it into volume, price, timing, and accounting drivers. Then I would inspect the general ledger, invoices, accruals, purchase orders, and operational metrics. For instance, a maintenance spike could reflect storm activity, a late invoice, or a capital versus expense error. I would discuss the result with the business owner, correct misstatements, and document whether the variance is recurring or one-time. Make sure to cover budget to actual analysis, prior period comparison, volume and rate drivers, accruals, reclassifications, one-time events, operational data, and documented conclusions with corrective action. Question 20. Why do you want to work in accounting at Duke Energy? Duke Energy interests me because its accounting sits at the intersection of infrastructure investment, regulation, reliability, and the energy transition. That creates work requiring both technical discipline and commercial judgment, especially around capital projects, regulatory recovery, and long-lived assets. I would bring strong reconciliation habits, curiosity, and clear communication with operational teams. I also value the public company responsibility to produce accurate reporting that supports regulators, investors, customers, and management decisions. In your answer, connect interest in complex regulated infrastructure, reliable financial reporting, energy transition investment, cross-functional partnership, public company accountability, and your specific strengths in analysis, controls, and communication. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.